Good morning and welcome this morning to Trading Futures. There's the opening bell, and so that means it is time to get started here this morning. Another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out in their chat by my good friend Brent Moores, who I've been working with for nigh on to the better part of 3 decades now, going into our third decade together as working in this field and together as coaching team. So glad to have Brent there. He's there to facilitate the conversation, keep things going out there in the chat. If you're in the recorded version, we're glad to have you here with us as well. Leave us a comment in the comment section. So this morning, some energy movement for sure, a little bit more geopolitical risk coming from some different places. That is impacting a couple of the ideas that we had already working. So we'll take a look at that here really quickly. Also, some movement in, because perhaps of that, some movement in cryptocurrency futures. We'll talk about that. As a matter of fact, that's kind of an extension of the cryptocurrency basics webcast that I teach on Monday mornings. So we'll talk a little bit more in depth about some of the things that we can do within this context. And some metals moving a little bit. Gold perhaps starting to move. We'll see if that bears itself out. Silver, as Gary points out, also starting to move. So glad to have you here with us. Let's jump in. A couple of quick reminders of all of the housekeeping items we need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation of any particular security or strategy or account type or anything else. Futures and futures options trading involves substantial risk. It is not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options prior to trading futures products. Also, it's a good idea to read the CFTC and NFA futures and Forex public disclosures, as well as the consumer advisories for virtual currency derivatives that come from the CFTC and from the NFA. We're going to talk about margin along the way, but remember that futures margin, which is also known as a performance bond, is the amount of money that you're required to deposit in your futures account to establish and maintain a futures position. We'll talk through a little bit of that. I'm planning a webcast in this time slot coming up in the future that's going to break down the mechanics of margin. I just want to make sure I've got the right way to explain that. So we'll talk a little bit more about it. Just make sure that you understand that when we enter a long or a short position in a futures contract, we are simply initiating that directional position. We are not necessarily buying or selling the contract. And in order to be able to do that, we've got to hold an initial margin account of cash in our account. And then to maintain that position, we've got to maintain a margin amount, which is typically lower. So we'll talk about that as we get into this discussion. Remember that investing involves risk, including loss of principal for some products and strategies, including futures products, loss of more than the initial investment. Real quick comment, stop orders that on futures contracts do not behave the same way that they do in an equity position. Stop orders, first of all, aren't guaranteed in execution. Due to exchange rules based on certain conditions at the time of activation, the exchange may reject or substitute an exchange designated limit order for the originally triggered market order that'll work within a protection range. If the market moves outside of that protection range, that order could be rejected or not filled at all. So we'll talk about that as we get into the discussion. Again, virtual currency derivative trading involves unique and significant risks. I already mentioned the investor advisories about those products. Make sure you understand the virtual currencies, which we're going to talk about today. It's a digital representation of value. It functions as a medium of exchange. It's not a legal tender. The risks associated with those products are still emerging, so just be aware of that. We're going to talk about these ideas in the context of our Thinkorswim desktop software platform, specifically the Paper Money platform. A great learning environment, not a guarantee of future success, but nothing is. And the Paper Money environment does not do certain things that a live trading account will do. Namely, in this context, studies in scans, first of all, number one, and number two, fill prices for orders. Normally, the paper money platform is going to fill at an algorithmically derived midpoint, whereas fill prices in a live trading account are going to fill based on market forces. So just be aware of that. Past performance, no guarantee of future results. We're going to talk about technical analysis. It's not a guarantee. Nothing is. Schwab doesn't recommend the use of technical analysis as sole means of investment research. So let's pop over here to the Thinkorswim desktop software platform as we get into this discussion and things get up and running. This morning, the S&P 500 E-mini futures, the /ES, starting to see a little bit of a pickup in momentum. Starting to see that RSI tick up a little bit here. I'm going to draw a line, and we can kind of see that 50-period moving average, in this case, acting perhaps as a little bit of a support level, getting a bit of a bounce here. We've got a downward candle, an equilibrium candle, and starting to pick up a momentum candle here this morning off of that 50-period moving average. A little bit below it, closed below it, in fact. And the first close that we've had below the 50-period moving average really in some time yesterday. And so that gives you an idea of how significant that downward move, even though it seemed small, that close below the 50-period moving average was the first time that we've closed below that level since April 7th was the last time we closed below that 50. That was an open above the 50. That was an open above the 50, and it continued to move higher. So we've been tracking above the 50-period moving average until yesterday's closing in that futures trading time frame. So we got that closing futures print below that level. Now, that would suggest that there is a potential risk here, as we saw momentum falling off. If momentum does continue to fall off, we get to move back below that 50-period moving average. 50-period moving average, in fact, kind of flattening out here a little bit up into this resistance right around the 76.40 mark or so. That this could be an inflection point. That close below could be an indication. Now, obviously, the last time we closed below, price was on its way up. But if we go back to this time frame back here, and I'm going to go back into the December-January time frame when we started to see, again, using that blue line as the 50-period simple moving average, we got to close below the 50-period simple moving average here on December 17th. And then we rallied up a little bit into the resistance level. Into the resistance level, we got a second close below the 50, which led to a third close below the 50, which led to a little bit of downward movement. Now, I'm not saying that that's what's going to happen here. Remember that past performance is not a guarantee of future results. The way that this did this before is not a guarantee of that. But if you want to think about, that crack in the armor, perhaps, that might be it. And no guarantee of that, but with that close below it, it was minor to be sure. But from small things come big changes, perhaps sometimes, right? And we've got a pretty solid level of resistance overhead there. So now that could be an indication that we see maybe a move, not necessarily in a downward direction, but maybe a pull back to a level of support. Now we're taking a look at the NASDAQ futures here. NASDAQ, again, I mean, this is a little bit different story. We've seen in the NASDAQ a little bit more downward momentum, some more closes below the 50. We saw a close here below the 50, a close here below the 50. These are now closing below the 50, starting to see a little bit of a pickup in momentum, but we're well below the 50 at this particular point and not making our way back, at least not yet. Perhaps running into that resistance level that was previous support. Old support can become new resistance, as we know. Doesn't have to, but it can. Taking a look at the Russell 2000, the small caps, and the small caps have not seen a close below the 50 since back there in April. And in that April timeframe, once again, same type of scenario. Prices were on the rise. We've not closed below the 50 since then. So, not that that's magical by any means. Not that the 50-period moving average is some kind of magical indicator and threshold or Rubicon that the market may cross. But And maybe that first indication, that first crack in the armor of weakness. We're not there yet on the Russell 2000. So kind of an interesting perspective. I'm going to pop over here really quick to our single grid, just our kind of playground, if you will. And I'm going to turn off a couple of these things here. I'm going to turn off that comparison line and those moving averages. I'm just going to leave that one. I'm going to change this one to our 50 again. And we're going to take a look at a couple of things. First of all, /CL. This is crude oil. And we were talking about this in our our options strategies workshop over the weekend out in the Chicagoland area. I'm just going to remove a couple of these lines that Rachel drew on my chart, just so that we can kind of see what's going. And so you can kind of see the upward momentum that's going on. Rally up, pullback, advanced block at a resistance level, in fact. Rally up, equilibrium yesterday, now a strong rally. In fact, up 2.66% on the day at the 84.70 mark or so, and just nudging, once again, that 50 period moving average. We've been well below the 50 really since the May 22nd timeframe, when we've stayed below that 50 since then. There's been some of that downward pressure. Here was that memorandum of understanding. Now with additional attacks back and forth and geopolitical risk and so forth, and now potential new front being opened up on the Houthi Peninsula, seeing some additional pressure to the upside in terms of crude oil futures. And so that has been driving, at least in the short to intermediate term now, crude oil prices back up from where they were down around that 67 mark. Now, this becomes kind of the starting point for the discussion that I want to have today. Two of the discussions that I want to have today. One is what's going on with energy prices and how is that impacting things. Two is how we might take advantage of this. And we started to do that a couple of weeks ago. So I'm going to go back over to my monitor tab, and I'm going to take a look at this relationship that we have right here. So we put on this crude oil futures calendar using the micro crude oil contracts. And the futures calendar was very simple. It was, we shorted the September delivery micro crude oil contract, and we went long the November. The expectation was that the front month, or the front expiration, the September, was going to get cheaper. All right, that's why we went short. And then the November was going to get more expensive. So we're trading that relationship between those two. And we wanted that relationship to get tighter. So when we put this trade on, when we initiated this trade, the width between those two prices, the width between those two contracts was $3.16. We wanted that width to narrow to less than that. It has now widened. In fact, it's widened to $4.41. I put this in a real quick chart over on the left-hand side of my my toolbox here, just to kind of see what's going on. I just put it in a quick chart just so that I can see the relationship there. And really, all I did is I just took this calendar spread, and it's essentially what's referred to as a time calendar spread on futures. I right-clicked on this position, and I just went to more info, and I sent it to my quick chart. And so now I changed my quick chart is set up to be displaying a line chart just so that I can see the width of this. So there was a point in time when we put this on, and I think we initiated this trade. Let me take a look at when we put this trade on. We put this trade on the 14th. So that was no, that was last week, wasn't it? That was last Tuesday that we put this on. So we go back to the 14th, And in fact, that was just about the time that things started to go haywire once again, right? We were expecting that prices on the front month were going to come down. They have not. And the width of that spread, where we put it on 714, has gone flat for a little bit, and now it is widening significantly. So what that means is this is working against us. Now it's working for us in the long side. The long side's getting a little bit more expensive, not hugely more expensive. It's gone from 76 when we put the trade on to 80, so $4 to the upside. But so has the short side in this case gotten more expensive. So that's working against us, and is working against us to a greater degree than the long side is working for us. So what we might look at doing here now, I get it. I mean, this is one of those, yeah, this is one of the possibilities in creating a trade that capitalizes on geopolitical risk or the lack thereof, is that the geopolitical risk can last a lot longer, perhaps, than our margin account can sustain a position. Now, here's the other thing to think about, though. Had we just gone short the September expiration here, had we just simply gone short thinking crude oil is going to roll off, that loss that we saw, that we are realizing here, could have been significantly larger. What's offsetting that is the fact that we're long the November. And that November is gaining value as the against the loss of the value in the short September. So trading it as a calendar spread mitigated some of that loss, and which is one of the reasons why there's some potentially margin relief in putting on a calendar spread like this and trading the width of that spread. However, this is kind of working against us at this particular point. And so given that fact, we could do one of a couple of things. One, we could close the short leg and leave that long dated November futures contract in there to rise. So the other part of that coin, however, or the other side of that coin, is that if prices started to unwind in the other direction, if there is a resolution, we saw that before, and we saw the very quick resolution to the width of this spread between these two on the memorandum of understanding, and we saw that very quickly move from 4 to less than 1 in terms of the width of that spread. That means both sides of this could unwind. So I'm more inclined at this particular point to simply take the loss, close both sides of this spread, and wait to reinitiate, because we could get a big unwinding, and that may take out any of those potential gains that we've got in the long side. So we're going to close this down and then look at reinitiating this calendar spread if in fact there seems to be some movement back towards narrowing the width of that spread between these two. So all I'm going to do here really quickly is right click, create a closing order, and we're going to buy back the calendar for $4.49, which we sold for $3.16 to begin with. So mitigated somewhat the loss versus trading one or the other. The problem is, while we expect that one is going to move up and one is going to move down, and that's going to be a nice and fair and orderly progression between those two in terms of that product depth and in terms of those positions, the challenge with trading a futures calendar spread is there are times when both might be moving in one direction and both might be moving in the other direction, or they might be moving in opposite directions that we expect. So there is a potential risk to take loss on both legs of this calendar spread. It isn't always as clean as if one moves down, the other one's moving up, or if one moves up, the other one's moving down. It's just not that clean. So attention must be paid. So we're going to close this trade down. We're going to work that down towards that mid. We're going to click on confirm and send. And we're going to exit this position simply from the standpoint that, boy, there's geopolitical risk afoot. We're going to wait until perhaps more of a resolution. Now, could we simply go long crude at this particular point? Yeah. But once again, there is that potential risk to that long position in the fact that if that geopolitical risk is taken off, that could unwind very, very quickly. So again, we could set a stop loss to that. However, given the uncertainty of it, that may be something that some traders may want to avoid. All right, so we've done that. We've closed out our /MCL calendar. Let's take a look at another position that I wanted to manage here really quickly, and we'll jump into a couple of new ideas. And this is /MNQ. So we're going to go back over here to our futures section in our monitor tab in our futures group. So we closed that MCL calendar. Now we've got this /MNQ, and we're short the /MNQ. This has been working in our favor for the most part, with the exception of today. Because remember, we go back to that chart that we were looking at, and let's look at /MNQ. And what's it been doing over the last few days since last week or 2 weeks ago? It's generally been going down. Now, it's starting to rise a little bit. It's maybe finding a little bit of a support level. So given the fact that we've got a little bit of a support level going on here, and we had put this on, I think, as a hedge against the long positions that we have in our portfolio that are generally more sensitive to the technology sector, I'm going to look at that possibility of closing this down and then maybe reinitiating a short position if we get a breakdown below this support level right here at about this 28,697 or so. So we've got a little bit of a rally higher. Now, you might look at this and say, well, maybe we need to see a close above the high of the low day to exit this trade. Well, we might not get it today. Maybe we will. That might be the if this then that type of statement. If price closes or moves above the high of this low candle, then close that down. So, there we go. That may be a possibility here as well. So let's go back over here to the monitor tab. I'm going to look at closing this one down, and we're going to take some of that gain that we've made in the trade. We're going to book that gain, which is now unrealized, and we're going to right click, and we're going to go ahead and we're going to create a closing order. And we'll get confirm and send, and we'll put this in our futures group, make sure that we're aware of that transaction to close. And we bought it back, closed the position. Now we are flat. All right. So the next thing I wanted to look at here really quickly, and this is something that's moving, and this is a continuation of the conversation that I started yesterday in the Cryptocurrency Basics webcast, is the relationship between /BTC and spot crypto. So what I want to do is I've got a grid here that I wanted to look at, and that is our single grid times 2. And what I've done is on the left-hand side, I've got the /BTC contract. On the right-hand side, I've got BTC /USD. That is roughly the proxy for spot crypto. That is the quote for what is considered to be the spot crypto price. Spot meaning just whatever at the moment on the spot delivery price is on the exchange. You buy crypto from some other exchange, they're going to add fees. The prices might be a little bit different. But right now, the spot cryptocurrency, spot Bitcoin price is sitting right at 666.51.51. You can see that that's changing. It's relatively volatile. You can see also, so this is 66640. You can see that the cryptocurrency future, the Bitcoin futures contract, the continuous contract, is currently sitting at 66,810, higher than the spot. Okay. So if we take a look at the relationship here, this is one of the questions that traders often ask, and this is an extension of the conversation that we had in the cryptocurrency webcast yesterday, is what drives cryptocurrency prices? Well, one of the forces that drives cryptocurrency prices is this difference between the futures price and the spot price. Because if there's a difference between the spot and the future, The futures contract is always, or generally, I don't, not always, but generally going to be higher than the spot price because time is valuable and time allows for prices to move up or down. So if there's an expectation of price movement in the future, there's also some carry costs that are associated with a future delivery date, especially with physically delivered products like crude oil or like metals, those types of things. And I will share this screen. Yes, absolutely. But the relationship here is this. There's an expectation that price is going to move at some point between now and the delivery date or expiration date of this futures contract or whatever the futures contract is. But there's a guaranteed scenario that happens. So if we take a look at a Bitcoin contract, let me kill this drawing. So if our Bitcoin forward slash BTC is trading at one level right here, and I'll just put BTC as our spot, that if it's trading at this level here, that at expiration, we'll just call that expiration or delivery, that whatever the spot price is at that particular point in time, this futures contract is going to meet that spot price. Right? Does that make sense? Because at expiration of that contract, that futures contract is going to be delivering spot. So if spot goes way up or goes way down, so let's do this. If spot were to go way down, then that price of the futures contract is going to go down and meet that spot price. If spot were to go way up at delivery, that futures contract price is going to move up to meet that spot. But in between now and that delivery date, there's a whole lot of time. Or maybe not so much time, depending on which contract you buy or sell. So in between that time, there is going to be a disparity between spot and, as there is now, spot and the futures. So an institutional trader could do one of a couple of different things. They could sell the futures contract and buy the spot. So sell and buy and take advantage of that basis difference, right? If there's a basis difference, that arbitrage between those two can help to bring those prices back into line with one another. Because if there's a big arbitrage, if this distance between spot and the futures is wide, then that's incentivizing institutional traders, large traders, to buy one and sell the other, or sell one and buy the other. And that brings that relationship back. It's the same mechanism that works for things like exchange traded funds or anything that trades that has a spot price that trades differently than another price on two different exchanges. That's arbitrage, right? Trading a similar product or same product on two different exchanges and the ability to profit from that difference in those prices. So that's how that relationship works. And it moves both sides of this equation. It moves the futures price and it also moves the spot price. Because remember, these are going to function on their own trading forces and their own levels of supply and demand. Spot is going to move because of supply and demand for spot. But spot's also going to be influenced by the supply and demand for the futures because of that arbitrage relationship and vice versa. So it's a self-leveling, if you will, for the most part, relationship. Sometimes it gets out of whack. When it gets out of whack, it's very quickly arbitraged out of the relationship. It doesn't last for very long. So don't look necessarily get caught up in the idea of looking for those mispricings. But that's kind of how that process works. So let's now that we have that relationship and we know what that relationship looks like, um, let's take advantage of or take a look at our futures grid here. And I'm going to come back down to our futures grid. Where did I put it? There it is right there. Futures grid with labels. And I'm going to pop in here to /MBT. This is the micro Bitcoin futures price and the micro Bitcoin futures contract. So taking a look in the right-hand side here, let's maximize this. Tick size is 5, so this moves without decimal points. It just moves in 5 increments. Tick value is 50 cents, so that point value is 10 cents. Notional value is relatively small. You take 10 cents times that price, gives you that smaller notional value. If we were looking at the big contract, that would be a much larger notional value. If we go to our futures drop down here, we can see that the initial margin for micro Bitcoin futures is 2,590. If we were to look at the initial margin on /BTC, the large contract where that tick size is not 10 cents, but that tick size is $25. Now you're talking about an initial margin and a correspondingly much larger notional value of $129,063. Just to you got to have that in your account to put up just to initiate a short contract. So from a capital efficiency standpoint, the micro contract becomes a little more efficient in terms of capital allocation. So here's the thought. This is our right-hand side. We can see that it's gaining some value here. And again, geopolitical uncertainty is one of the forces that drives this type of movement. So I'm going to pop over here to the right-hand side. We're going to maximize this particular cell. And I was looking at this kind of resistance level in the overnight time frame. We've bounced below it, now rallied back above. So what I'm going to do is look at this. So we've got a little bit of a push to the upside. We might see a little bit of a bull flag move here, but I'm going to maybe go long in this contract just in kind of the shorter term time frame and maybe take advantage of that push to the upside. Could it pull back? Yes. In that case, if it does, I'm going to stop this trade out theoretically at a relatively small distance where a break below that level may suggest a roll back over and move back down to the downside. So we're going to look at getting in, and I might put my stop here. I'm maybe going to give it a little bit to begin with and then move that stop up as this continues to move. You can see that the trend strength is gaining here. So rather than continuing to talk through it, I'm going to do this as a buy custom with stop. Now, I'm not going to put a target on it at the moment, although we certainly could. But I'm going to put that initial stop right down here at 66,523. So 66,523 is going to be my initial stop in this trade. 66,523. And I'm going to make that good till canceled so that it doesn't go. And I'm going to leave it as a market order because I know that it's going to get worked as an exchange designated limit order. We could make that a stop limit order if we wanted to. But now I'm going to look at entering this trade on a limit because it's already broken above that resistance level. So I simply want to get in here on a limit no higher than where it is at that high, which is 66,979. So I'm at 66,955. I'm going to give that to 66,960 as a limit to get into the trade. And I'm going to make that a day order because if this reverses on me quickly, I want to get in if this pulls back just a little bit here. So we're going to go ahead. I'm going to just do one contract. We can click on confirm and send. Here's my transaction costs. There's my buying power effect. One thing I need to do is I need to edit that stop because sometimes in the futures orders, it defaults to auto, but sometimes when the order gets sent, it creates a new open position, which would reverse that position. So I'm going to go ahead and I'm going to close that or make that to close. Click on confirm and send. Make sure that order is to close. And transaction costs, there's my initial margin in the trade. and I'm going to put that in my futures group here. And again, this is not a recommendation, it's simply an illustrative example. And we got it in at 66,955, which is where it's currently trading. Now, given the fact that it has been moving to the upside, I can pop over here to the left-hand side and kind of zoom in a little bit, and we can say, all right, now we're in. Where might there be a resistance level that we could use as a potential target if we wanted to take this off on a target at a target order to get out of the trade? So that's a possibility as well. We could do that. We'll watch this as this continues to move. Now, that was one area. Now, the last one I wanted to look at really quickly before we go. And look, you can see that I've still got that quick chart pulled up. We were sitting at 4.41 on the width of that calendar spread, that micro crude oil calendar spread. It is now moved from 4.41 to 4.49. So the width is getting wider, which means that very likely in the short term, that front month futures on crude, that September delivery is getting more expensive, which means the crude prices are going up. But for the same reason, for one of potentially the same reason that, let me restore these cells, potentially the same reason that Bitcoin it might be moving up because of that geopolitical instability, /MGC. Gold is also potentially moving up. Now, we saw a little bit of a pullback, but over the course of the last day or so, we've seen some move up off of this support level. I'm going to zoom in on this right-hand side, kind of doing the same thing that Bitcoin was doing. Again, they are not the same. Gold behaves slightly differently than Bitcoin, although some traders call it digital gold. It is not. There are different forces at work, but notice what's going on here in this /MGC, the micro gold contract. I've got a little bit of a support level that's now established itself down here. I've got a support level that I had drawn in before that had kind of broken down. Yeah, so RB Tech asks a great question. Can it be combined with the stop as an OCO so the stop is canceled and the target's hit? Yeah, and in that particular case, what we would do is go in and cancel and replace the stop order with the OCO bracket order, and we would just change the order to meet that. As a matter of fact, there's some great webcasts out there that talk about creating those OCO bracket orders and manipulating them. So I'll link to those. I'll show you those out here in the webcast page in just a minute. But what I'm going to look for here in this particular case, ADX is, let me pop into this particular cell right here. ADX is starting to pick up a little bit. So we're starting to gain some trend strength. And remember that that trend strength. Yeah, so Brent got it too. We're canceling the first one. So when we do the cancel replace, we're canceling the first one and we're replacing it with a new order, right? So we're replacing it with a new OCO order. So when I say manipulating it with that cancel replace, that's what we're doing. But we're getting that bounce up above. We've broken out of this resistance level. Now we're looking for a break above this diagonal trend line. ADX is starting to increase. So we're starting to get that directional strength because remember, ADX doesn't care what direction the price is moving. It just tells us how strongly that move is being accomplished. So we've got a short-term move to the upside and it's gaining strength. If that gets above that 25 level, then that's going to become a strong trend. My guess is that if price moves above this diagonal trend line, then that is likely to become a strong trend. So what we're going to do is I'm going to put together a short-term upward trade potentially on this MGC contract. I'm going to trade it back up to this previous high. So I'm going to draw a line here at 40.88, just under that 40.90. And that's going to be my target. So I'll just put a T there for target, just so that we can see it. There's a T for target. And then my entry is going to come on a break of this level at 40.64. Right? And I might even make it a little bit higher here. I might go 40.66 just as a means to give it a little bit of a buffer above that level so that we don't get kicked in and then right back down. And then I'm going to stop this out on a break below that support level right here at the 40.48 level. So we're going to make that our stop in this trade. So just distance-wise, just looking at this is about a 2-to-1 trade, maybe a 1.5-to-1 trade to the upside. Now, we could continue that conditionality and put in a conditional order on the ADX being above the 25 level. We're right about there. In fact, we're just at 25 right now. It started to tick back up as we get a new 5-minute candle ticking in here. So I'm still going to be looking for that 40.66 break to the upside. So I'm going to right click and I'm going to do a buy custom with OCO bracket. Buy custom with OCO bracket. And I'm going to do this as a buy stop. Remember, a buy stop is going to work the same as a sell stop. It's going to get worked as a market designated or an exchange designated limit order. I'm going to make that 40.66. And I'm going to make our target 40.89. 89. It's a little bit different than the 4900 or 4090, which is a big round number. Make that good till canceled. And I'm going to make our stop that 40.48. 40.48. And there's our stop in this particular case. And we're going to make that good till cancel. And again, that stop to the downside is going to be a sell stop, but that's going to get worked as an exchange designated limit order. But it says stop, wait, don't do anything until price breaks 40.48. Then send out a marketable order, which is then either going to get moved through and rejected, or it may get filled within that protection range. But that's going to be a designated order by limit order worked by the exchange for their protection as well as ours. But there is risk there in that particular case, and that order never fills because it gets rejected in a fast-moving market. So I'm going to go ahead and click on confirm and send. Oh, and we also need to make sure that these are closing prices or closing orders. Now we'll go to confirm and send, make sure that those say to close and to close. Read through this. Our initial margin in this contract, 3,614. We're going to put this in our futures group, and we're going to look for that upside move. And we're just getting that breakout right now. We'll see if that order fills. We're just under that 40.66. We'll see if maybe we don't get that fill here. We'll see. And we got it at 40.66. That was our buy stop, right? Stop, wait, don't get into the trade until price moves through 40.66, which gives us that initial that additional confirmation that price is moving higher here. So trend strength is increasing. We're getting a pretty strong momentum breakout to the upside here, and our target is up here at that 40.89 level. So might not get there, might turn around, but that's the way that we're structuring this short-term trade. So we're going to pop over here really quickly to the futures page at Schwab, schwab.com/futures if you want more information about trading futures at Charles Schwab. If you want to learn more about those OCO orders or about cryptocurrency and the Cryptocurrency Basics webcast or arbitrage, this is a great place to go. I'm going to type in here OCO orders, and there's a bunch of webcasts in here that talk about guide to placing options orders from beginner to advanced. That's also relevant here. Brent Moores, this is Brent Moores right here. And this is a great short form video, 10 minutes, talking about order types, advanced orders. So Brent knows this stuff probably better than I do. And so that is a great place to go to learn a little bit more about how you might manipulate that type of OCO order. By the way, if you're going to be in the New York area coming up, the next time that we're going to be talking about futures in our in-person events is going to be our August 28th and 29th Advanced Option Strategies Workshop. We're doing 1/4 of one of the days that we're there talking about introduction to futures. And so we're going to talk through that futures discussion. So we'll discuss it live in person. So you can join us for that if you're in that area. Otherwise, we're going to be in Dallas coming up on August 1st. Then we're going to be in Orlando on the 7th and 8th. And then after that, we're going to be in Scottsdale in September. And gosh, how is it almost August by now? Guys, thanks for joining me. Thanks for our great reviewers and our great production staff. And of course, thanks to Brent Moores and to all of you. Make sure that when you go to that webcast page, you click on the subscribe button, give us a follow on social media, and we'll see you again very soon. Take care, everybody. Bye bye.